It's happening. The short squeeze has officially begun. Do you believe major opportunities are announced with fireworks? You have made a structural mistake. The short squeeze is not a possibility. It is a fatality already in motion. Right now, short sellers are trapped. Positions are being forced closed. Structural data proves the pressure is unsustainable. The fuse for forced buying is lit, and most investors will ignore it until it is too late. Do you have a plan for when the forced buying mechanism sends prices vertical without warning? People think a short squeeze starts when the price explodes upward. That is the fundamental mistake. For the general public, yes, they notice it when the price goes vertical. But by the time the price goes vertical, the real opportunity is already gone. That's just the panic phase where smart money takes profit. A short squeeze starts much earlier, in the darkness of the market structure, weeks or even months before the explosion. It begins with three silent cumulative factors that build structural instability. 1. Invisible structural pressure, the market absorbing massive selling volume without dropping, signaling heavy institutional buying beneath the surface. 2. Massive positioning imbalance, too many participants betting on the same side of the boat, the short side, making the trade crowded and inherently fragile. 3. Critical positioning mistakes. Short sellers choosing to double down on their losing bets, increasing their short interest, and making their vulnerability exponential. And that is exactly what we are witnessing right now. This phenomenon is not driven by simple optimism or bullish news. Markets do not move because of the news you read on your phone. They move because of the forced behavior of bid players. When institutions, hedge funds, and algorithms are compelled by their own risk management rules to buy to cover a short, the resulting price movement is inevitable, non-negotiable, and brutal. The short squeeze is the purest manifestation of that market physics. But do you really know why a short seller cannot simply wait for the price to drop? Understanding their unlimited risk is the key to predicting the squeeze. Let's strip this down to the core fundamentals. A short squeeze is not a pump and dump scheme. It's the inevitable consequence of structural betting gone wrong. A squeeze happens when too many traders are short, creating a massive pool of future buyers. Price refuses to go down, confirming the market has found a durable bottom. And those shorts are forced to buy back at higher prices, initiating the devastating feedback loop. Short sellers operate on borrowed time and borrowed shares. They sell those shares immediately and hope to buy them back cheaper later. But here is the single biggest problem. Unlike a traditional buyer, whose maximum loss is 100% of their investment, a short seller can theoretically lose infinite money if the price goes vertical. This is the core structural danger. The danger accelerates when the position moves against them. At a critical, mathematically predetermined point, margin requirements increase. Brokers demand massive additional collateral to maintain the position, forcing shorts to inject cash or liquidate other assets. Brokers force liquidations. If the short seller cannot meet the margin call, the brokerage is legally obligated to buy the shares on their behalf, regardless of the price. Systemic stop losses get triggered. Algorithmic exits fire off, adding fuel to the fire. When these trapped shorts buy back to exit, they are suddenly converted into powerful, desperate buyers, not sellers. That forced, inelastic buying pushes price aggressively higher, which forces more shorts to exit, which pushes price even higher. That is the squeeze. It is the most powerful feedback loop in finance. Short squeezes seem like black swan events, but they are predictable. They require three very specific hidden ingredients to create the necessary instability. Do you know what those structural ingredients are? Short squeezes are not random acts of fate. They are a predictable consequence of a highly specific structural setup. This volatility is built on three pillars of instability. 1. Excessive short interest, the volatility fuel. This is the required fuel for the explosion. When too many institutional participants are positioned on the same side, betting against the asset, the market becomes inherently unstable. It's a crowded trade. Crowded trades, especially crowded short trades, do not unwind gently, they break violently. Right now, Short interest remains critically elevated, even after the market has moved up. That is the most important signal. It tells us the shorts haven't capitulated. They're still holding their losing position, hoping for a bailout drop, and that refusal to admit defeat makes their position exponentially dangerous. 2. Price refuses to break down. The warning sign. This is the structural anomaly that should terrify any short seller. Despite the heavy bearish positioning and potentially bearish news cycles, the price simply stops going lower. Bearish catalysts that should send the price down are absorbed silently by strong institutional buyers. When bad news stops working, that's not a pause in selling. That's accumulation. It means someone large and powerful is defending the asset, building a massive long position directly under the shorts. 3. Rising borrow costs and invisible pressure. This is the ticking clock. As shorts remain trapped and short interest stays high, the pressure behind the scenes tightens. Borrow fees to hold the position rise, margin requirements tighten, and internal risk managers at hedge funds get nervous. At first, this pressure is invisible to the retail trader. It shows up in obscure data metrics. But suddenly, it turns into a margin call, forcing liquidation and initiating the squeeze sequence. Time is now the enemy of the short side. We know the deadly setup is fully in place, but how do we confirm the ignition that the short squeeze has officially begun? There are 3 key non-negotiable signals you must see on the chart right now. This is the most critical section of this video. We established the setup is dangerous, but this is how you confirm, with pure data, that the short squeeze has officially moved from a setup to an ongoing reality. Signal number 1. Higher lows under sustained short pressure. This is a structural shift that changes everything. When an asset begins making consecutive higher lows, the low points of market dips are getting higher, while simultaneously short interest remains elevated or even increases. That is the sound of the trap closing. It means that the committed buyers are stepping in earlier and earlier, systematically draining the available supply, while the short sellers are losing control and getting dangerously uncomfortable. This structural support is one of the earliest and most reliable squeeze signals. Signal number 2, failed breakdowns and quick absorption. The second, unmistakable signal is the complete lack of follow-through on selling. Pay attention to what happens when price dips below a key support level, attempting a breakdown. If every single dip, 1. Gets bought back up quickly, 2. Fails to gain any selling momentum, and 3. Snaps back aggressively above the key level. That is not market weakness. That is forceful absorption. It confirms that institutional capital is positioned to buy every single short-driven panic sell. Absorption is the final mechanism that bankrupts shorts because it systematically destroys their conviction. Signal number 3, time and cost working against shorts. The longer the price stays elevated and refuses to drop, the more pressure builds invisibly on the short side. They are in a race against time, and time is expensive. Short sellers are paying 3 major invisible costs. 1. Borrow fees, interest on the borrowed shares. 2. Opportunity cost, capital locked up in a losing bet. And 3. Psychological stress, the daily fear of unlimited loss. These costs compound daily, turning a theoretical position into a guaranteed hemorrhage. Time favors the long side in a crowded short trade because the shorts are perpetually underwater and drowning slowly. We know the mechanism is deadly, but why exactly are shorts so dangerously trapped right now, instead of simply exiting their bets? The answer lies in their entry points. This is the core psychological vulnerability of the short side. Most of the current shorts didn't enter at the absolute top price. If they had, they might have already exited. Instead, they are the persistent shorts, the ones who entered. On breakdown attempts, they bet the price would crash through key support levels, but price was absorbed. On failed rallies, they faded small uptrends, confident the momentum wouldn't last. On obvious resistance, they initiated short positions at levels they believed were impenetrable ceilings. The fatal error: the market never followed through on their bearish thesis. Now, the price is not just high. It's specifically above their entries, systematically holding key psychological levels and grinding higher slowly and painfully. This is the worst possible scenario for a short position, nicknamed the slow bleed, because they have two conflicting impulses. 1. Denial. They don't want to cover yet, believing they are right and the market is wrong, waiting for that final drop. 2. Cost. Every single day they hold, the borrow fees, the margin risk, and the psychological stress compound. This slow, constant pressure forces them into an impossible choice. They wait, they lose confidence, and eventually, one single, unexpected event, a sudden news cycle, or a large buyer breaks their collective willpower and triggers the inevitable cascade. We know the slow bleed is active, but what is the catastrophic endgame? The acceleration phase of a squeeze follows 4 rigid psychological steps. Which phase are we entering right now? The acceleration phase of a short squeeze is a rigid psychological and mechanical event. It follows 4 clear, distinguishable phases. If you can identify the current phase, you know the severity of the coming move. Phase 1. Denial and entrenchment. This is the slow bleed we just discussed. Shorts believe the current upward move is a mistake, a temporary fluctuation, or a false signal. They refuse to admit defeat, leading them to aggressively add to their short positions, doubling down, or stubbornly waiting for a bailout, increasing the total fuel available for the explosion. Phase 2. Stress and liquidity traps. Price continues its slow grind higher. This is where psychological stress peaks. Volatility increases subtly, borrow costs accelerate daily, and key stop-loss levels get closer. Funds begin to tighten their internal risk. They are not yet liquidating, but they are preparing for the worst, creating a liquidity vacuum right before the explosion. Phase 3. Forced buying ignition, the squeeze. This is the non-negotiable mechanism. A sudden event, like a margin call or a failed support test, triggers the forced exit. This includes mandatory margin calls from brokers, cascading stop losses from algorithms, and involuntary liquidations. This forced, immediate, inelastic buying is the ignition switch. This is when price moves fast, jumping quickly above key psychological barriers. Phase 4. Media attention and retail panic. Only now does the general public notice. The headlines appear. Stock X up 50%. Unprecedented rally. Retail traders pile in, drawn by the vertical move, often buying the absolute top. By this point, the smart money, the initial buyers who recognize the structural setup, is already using this retail panic to exit their positions profitably. We have seen historical squeezes before. But why is the current structural setup right now generating volatility conditions that feel uniquely dangerous? While the mechanics of a short squeeze are always the same, the environment they occur in changes. And this particular setup has unique ingredients that make the coming volatility potentially historic. Factor 1. Extreme positioning imbalance and persistence. We are not just seeing high short interest. We are seeing persistent, high short interest despite multiple bullish warnings. The shorts are not just short. They are stubbornly wrong, creating an imbalance that is at a multi-year extreme for this particular asset. This means the fuel tank for the squeeze is overflowing. Factor 2. Critical structural support under price. The price is being defended not by retail enthusiasm, but by deep-pocketed institutional buyers. This structural support, often invisible on smaller time frames, removes the short seller's exit ramp. It ensures that the only way out is up, not down. Factor 3. Liquidity conditions favoring explosive volatility. In the current market environment, liquidity, the ease of trading without affecting the price, is lower than normal. Lower liquidity means that when the forced buying of the squeeze starts, the price will gap up much faster, with less friction, translating directly to more violent vertical movements. Factor 4. Complacency and recency bias. This is the most dangerous factor. Many traders believe we already saw the major short squeezes, referencing past events. That belief is a catastrophic vulnerability. Short squeezes do not adhere to media narratives. They are structural events. They don't announce themselves with fanfare. They reveal themselves only after the pressure becomes unbearable. That complacency ensures maximum trapping when the final move begins. This setup is dangerous, but the biggest, most costly mistake traders make is psychological, waiting for final obvious confirmation. What is the true cost of delaying your plan until the big green candle appears? This is the final costly error made by 90% of retail traders. Most people wait for absolute, undeniable confirmation before acting. They wait for the media headlines, for the asset to become a viral meme, and for that final dramatic sequence of massive green candles. But here is the brutal truth of the structure. By the time the confirmation is obvious, the opportunity's already gone and the risks have multiplied. Waiting for obvious momentum ensures three catastrophic consequences. 1. Risk is maximized. You are entering the trade at the highest point of the move, directly into the hands of the smart money who are looking to exit. 2. Upside is minimized. The percentage gain from your entry to the peak of the panic phase is small, while the initial structural move that trapped the shorts is missed entirely. 3. Volatility is extreme. The final phase of the squeeze is the most chaotic, making stop-loss placement almost impossible and increasing the chance of being shaken out before the true peak. The best opportunities in this structural setup happen when the squeeze is just beginning, when the price is frustrating, the volume is increasing subtly, and the public is still in disbelief. This is where we are right now, in the quiet structural accumulation phase before the media notices. We've analyzed the profit potential, but we must discuss the other side of this high-risk scenario. What is the catastrophic risk that kills late buyers when a short squeeze finally runs out of fuel? Let's anchor this analysis in reality. Short squeezes are not guaranteed profit. They are high volatility events, and they possess severe risks. The biggest danger is not that the squeeze won't happen, but that the initial structural buyers will use the final panic buying frenzy, phase 4, to exit. Short squeezes can 1. Reverse violently. When the forced buying is exhausted, the price often crashes just as fast as it rose, trapping those who bought the media headlines. 2. Punish greed. Chasing the vertical move driven by FOMO leads to buying the absolute top and getting caught in the crash. 3. Break structure. The thesis relies entirely on the structural integrity of the setup. If an unexpected, massive bearish catalyst enters the market, or if the key support level is finally broken, the entire short squeeze thesis is invalidated. This is not a chasing game. It is about understanding the structural pressure. If the core structure, the higher lows, and the lack of follow-through on dips breaks down, you must reassess your position immediately. Discipline matters far more than conviction. Always understand your exit before you define your entry. The structure is in place, but we need final confirmation of acceleration. If the squeeze begins to accelerate, which 3 non-negotiable data points are the absolute necessity to watch for continuous momentum. The structural setup is complete, the shorts are trapped, and the pressure is building. To validate the acceleration phase, you must watch for a confluence of these 3 non-negotiable data points. These confirm the squeeze is progressing, not fading. 1. Accelerating short interest changes. The key is not just that short interest drops, but that it drops aggressively over a very short period. This confirms the mass liquidation phase, phase 3, has begun. Watch for sudden drops in the official short interest report, indicating forced exits. 2. The persistence of failed breakdowns. We need to see the continued pattern of price attempting to fall, being instantly absorbed, and snapping back. If the price starts holding significantly below a key support, the thesis is weakening. If it continues to snap back, the absorption is confirmed. 3. Explosive volume on up moves. On days where the price gains ground, the volume must be significantly higher than the average volume on down days. This divergence confirms that the buyers, forced and voluntary, are overpowering the supply, fueling the acceleration. If these 3 metrics remain aligned, accelerating short coverage, continued absorption, and explosive up volume, the squeeze is not done. It's just getting started. Short squeezes don't begin with explosions. They begin with pressure. And pressure is building. Positioning is wrong. Price is holding. Time is working against shorts. That's the recipe. Whether this becomes historic or not depends on one thing: how long shorts refuse to admit they read wrong. Because markets don't care about opinions. They care about forced behavior. And that's why it's happening. This is not hype. This is structural mechanics. Understand the danger, recognize the signals, and be prepared for the moment the market moves from pressure to explosion.